So this is pretty cool. Just as the housing market's starting to see some sort of recovery, granted fabricated recovery, but still some sort of recovery, FHA chimes in and says, hey guys, we have like 1 out of 6 loans delinquent right now. 1 out of 6 loans delinquent? Come on, FHA, you're supposed to be the rock in this crazy mess. What gives?
What gives is when the market dropped and subprime went away, it never really went away. It just got funneled over to FHA. And now, 5 years later, we're seeing the consequences of that. The 580 borrowers never really went away, they just got moved over to FHA rather than the subprime 80/20s that everybody got accustomed to.
So here's the deal, FHA has been showing signs of being overextended for quite some time now, hence the mortgage insurance hikes over the past several months.
They're obviously trying to shore up capital, and it doesn't appear to be working, as now their delinquencies are out of control.
In a recent report from Fitch labeled, "Oh snap, FHA's in trouble," okay, it's really not labeled that, but it should be. The report says that 8 of the largest U.S. banks now have $79.4 billion in delinquent loans.
And of that, 83% represent government-guaranteed mortgages.
That, my friends, is no good and could and will lead to some big changes for the most commonly used product in housing.
The report goes on to say that non-guaranteed loans, or basically conventional loan delinquency rates, are on the drop, but FHA is showing a stark difference. Take a look at this. Since 2008, FHA-insured loans have taken up a sizable role in the origination market. In 2005 and 6, FHA loans were only 5% of the entire pool.
Today, they make up roughly 1 out of every 4 originations and reached a high of 30% in 2009. In other words, these loans were made after the bust, so home prices were already correcting lower, but yet they entered the default pipeline rather quickly. Why? Well, because a 30 times leverage is freaking insane. Heck, we're talking about leverage ratios that brought down Lehman Brothers, and this is exactly where FHA is right now. Way overextended.
FHA just wasn't built for this type of exposure, and now it's so far out of control they aren't sure what to do about it. And it really doesn't take a rocket scientist to figure this one out. I mean, FHA's mission is for affordable housing, yet they have a loan limit in California of $729,000.
Last time I checked, $729,000 wasn't affordable housing, and it's crazy guidelines like this that have the government-backed loan in so much trouble. Hey, I like financing a $500,000 deal just as much as the next guy, but not to the demise of FHA.
And the other thing, it's not just purchase transactions either. Take a look. You can see that the refinance activity has picked up as well for FHA.
Here's the problem in 2012. There's little appetite for more bailouts. Fitch Rating actually feels that with worsening conditions that FHA may need to renegotiate loans back to the bank. In short, basically FHA stops paying out mortgage insurance claims and starts to force more buybacks to the banks. Aha, that sounds familiar, doesn't it? Sounds like what we just experienced with conventional loans.
Fannie and Freddie refuse to pay in some cases and push the faulty loans back to the banks, and we all know how that's playing out.
It's a bit maddening, really, because everyone says, well, what happened? I thought we were giving out good loans. Well, yeah, per 2005 standards we were, but just because we're checking pay stubs and W-2s doesn't mean that we're really giving out good loans for said borrower. You got a 580 credit score for a reason, guys.
And we all know that history does serve as a guide. If they have a history of not paying their bills and barely enough money for a down payment, maybe, just maybe, we should think twice about making that loan. Now here's the real question for all of us, because we've all been using FHA like it's going out of style, and well, the funny thing is, it's about to.
The question is, do we sit by and do nothing and let the FHA market crash? Or this time around, do we learn from our past mistakes and make the preemptive changes to the product? This would be the true test for the housing industry. Do we all just care about our next paycheck so much that we'll let FHA kill themselves? Or can we look past the next 30 days and see that FHA is very important to the industry, and maybe, just maybe, we need to make some self-preserving changes to FHA to ensure that it'll be around for future generations to use? Well, only time will tell. As for me, make the changes. Increase the minimum credit scores, lower the maximum loan amounts. It'll hurt initially, yes, but at least they're going to be around for the next 5 years. What say you, Resource Nation? Let us know your thoughts down below. And this is a very important show, guys. We'd really appreciate it if you could forward it on to everybody you know. See you next week.